March 9, 2020. The weekend had been brutal. Oil prices had just collapsed in a price war between Saudi Arabia and Russia. Global markets were already reeling from the first wave of pandemic fear. Before the opening bell even rang in New York, the futures market was signaling a bloodbath. The S&P 500 E-mini futures were limit down, locked at a 5% loss, unable to trade any lower. The message was clear. A wave of selling was about to hit the cash market. And it did. The bell rang, and within 4 minutes, the S&P 500 plunged 7%. Then, everything stopped. Not a glitch, not a power failure. The entire U.S. stock market just paused. For 15 minutes, the screens froze. That coordinated silence wasn't a sign the market broke. It was a sign the market's safety systems were working exactly as designed. This intentional stoppage is called a market-wide circuit breaker. The official story is simple enough. It's a timeout designed to calm panic and prevent a disorderly rout. The idea was born from the ashes of another crash, October 19, 1987, Black Monday. On that day, the Dow Jones Industrial Average fell nearly 23%. The postmortem revealed a nasty feedback loop, driven by a new strategy called portfolio insurance. This was an early form of algorithmic trading. When the market fell by a certain amount, the computers would automatically sell index futures to hedge. But when everyone's computers tried to sell at the same time, it pushed the market down further, which triggered even more selling. A doom loop. The original circuit breakers, implemented in 1988, were meant to break that cycle, to give humans a moment to intervene, to think, before the machines took over entirely. The rules have evolved since then. In 2013, the system got a major overhaul. Instead of being triggered by a specific point drop in the Dow, which becomes less meaningful as the market grows, the triggers were pegged to percentage drops in the broader S&P 500 index. Today, there are 3 levels. Level 1 is a 7% drop from the previous day's close. That triggers a 15-minute pause. Level 2 is a 13% drop, which also triggers a 15-minute pause. And Level 3, the big one, is a 20% drop. If that hits, trading is halted for the rest of the day. A total shutdown. And timing matters. If a level 1 or 2 is triggered after 3:25 p.m. Eastern Time, trading continues to the bell. The idea is that with only 35 minutes left, a pause would just create a more chaotic close. But a level 3 can stop the market at any time. These are the tripwires for the entire U.S. equity market. But calling it a timeout to calm panic doesn't capture what's really happening. It's not about feelings. It's about plumbing. The 15-minute pause is a window for the market's internal machinery to catch up. To understand this, you have to see the market not as a single entity, but as a network of different players with different constraints. First, you have the market makers and high-frequency traders, the liquidity providers. In the seconds before a halt, as selling accelerates, their risk models are screaming. The value of their inventory is collapsing, and the future is deeply uncertain. So they do the only rational thing. They pull their bids. They widen their buy-sell spreads to infinity. The screen goes blank. That's a liquidity vacuum. The halt forces everyone to stop. Simultaneously, at hedge funds and other leveraged players, automated alerts are firing. Margin call. When the value of their positions falls, their brokers, the prime brokerages at big banks, demand they post more collateral to cover potential losses. This isn't a friendly request. It's an automated, contractual obligation. But posting collateral isn't like sending a wire transfer. You have to decide which assets to use, cash, treasuries, and physically move them between accounts. This takes time. Those 15 minutes are a lifeline. It's time to contact custodians, arrange transfers, and satisfy the margin call without being forced to liquidate positions into a collapsing market. It's the pause that stops the doom loop. Falling prices trigger margin calls, which force selling, which pushes prices even lower. The halt buys time to feed the machine with collateral instead of forced sales. So, the market makers have reset and the funds have posted margin. Now what? The restart isn't a free-for-all. It's a highly structured event called a reopening auction. Instead of the market resuming its chaotic continuous trading, all buy and sell orders submitted during the pause are pooled together. The exchange's matching engine then calculates the single price at which the most shares can trade. This is crucial. An auction concentrates liquidity in time. Instead of 1,000 tiny, panic trades at slightly different prices, you get one big, transparent trade at a single clearing price. When trading resumed on those mornings in March 2020, the price was often still lower, but the bid-ask spread was tighter and the order book was deeper. The halt didn't stop the fall, but it replaced a stampede with an orderly queue. The story gets even more interesting when you realize the U.S. stock market doesn't operate in a vacuum. Price discovery never really sleeps. It's a 24-hour process that follows the sun, from Asia to Europe to New York, primarily through futures markets. The opening bell in New York doesn't start the day. It just picks up the baton from the overnight futures session. But what happens when that futures runner is already on the ground? Throughout March 2020, S&P 500 futures repeatedly hit their 5% overnight limit down level. This froze the futures price, but it didn't freeze the selling pressure. It just bottled it up. All that pent-up desire to sell was then unleashed at 9:30 a.m. when the cash market opened. The result was a waterfall. The 5% futures limit channeled a wave of selling directly into the 7% cash market halt. One circuit breaker fed directly into the next. It's also important not to confuse these market-wide halts with another, more common type of pause. Following the flash crash of May 6, 2010, an event where there was no market-wide halt, but hundreds of individual stocks saw their prices evaporate and then snap back in minutes, regulators introduced limit up, limit down, or LULD bans. Think of it as a circuit breaker for a single stock. Every security trades within a dynamic price band, a corridor around its recent price. If a trade tries to happen outside that band, the stock is put into a 5-minute pause and a reopening auction is held. This happens all the time without the broader market noticing. It's a tool to prevent the kind of freakish air pockets we saw in 2010, and it runs in parallel to the big, market-wide system. But circuit breakers are not a magic bullet. Calibrate them incorrectly and they can make a panic worse. The textbook example is China in January 2016. The Chinese market, heavily dominated by retail investors, was coming off a massive bubble. Authorities decided to introduce a new circuit breaker system. A 5% fall in the CSI 300 index would trigger a 15-minute pause. A 7% fall would shut down the market for the entire day. The problem wasn't the idea, it was the numbers. The thresholds were far too tight. A 7% daily move is volatile, but not unheard of. It wasn't a safety net, it was a finish line. Traders knew that if the market hit -5%, there was a very real chance it would quickly hit -7 and the exits would be locked. This created a perverse incentive, the race to the exit. The first halt at 5% acted like a starting pistol for a sprint to sell everything possible before the final 7% gate came down. The system amplified panic instead of calming it. It was abandoned after just 4 days. When you zoom out from these events, a pattern emerges. Market crashes are liquidity events before they are valuation events. Think of it like a crowded theater. If someone yells, "Fire," the immediate problem isn't the quality of the play, it's that everyone is trying to get through the same narrow door at the same time. The price of getting out becomes astronomical. In markets, a crash is a sudden, desperate demand for liquidity, for cash, that overwhelms the available supply. Halts do nothing to change the long-term value of the companies being traded. They are a piece of market architecture, a form of crowd control. They widen the door by pausing the rush, forcing a reset where buyers and sellers can find each other in a more orderly fashion. They address the stampede, not the reason for the stampede. So, what's the big takeaway? Markets don't just set prices. They are complex systems for managing traffic and risk. And sometimes, the smartest thing a system can do is take a breath. A circuit breaker is not an airbag. It won't prevent injury. A bear market is still a bear market. Prices will land where they land. It's a guardrail. It's designed to keep the car on the road during a sharp turn, to prevent it from skidding off the cliff into pure systemic chaos, where prices become meaningless and the entire mechanism of exchange breaks down. They are a confession that markets, left entirely to their own devices in moments of extreme stress, can produce feedback loops that are destructive to the market itself. The pause is a feature, not a bug. It's the market's way of protecting itself from our own worst instincts. So the next time you see the tickers freeze, don't think of it as failure. Think of it as the plumbing, working as intended, deep behind the walls. If you appreciate understanding the hidden mechanics and human incentives that drive markets, you're in the right place. That's what we do at Tickerlore. No hot tips, no predictions, just clear, sharp stories about how the machine really works. Subscribe and hit the bell so you don't miss our next breakdown. Drop a like if this helped you see market halts in a new light. We'll see you next time.